And joining me now in studio to talk more about equities, your portfolio, and where we head from here is David Stryzewski. He's the CEO of Sound Planning Group. David, thanks for joining.
Pleasure to be here.
Always great to talk to you. And of course, a lot's happened in this market just in the past 24 hours, let alone the past few months or so. What are the conversations that you're having with your clients right now?
You know, Kristen, I think that really the sentiment right now is that we have a different direction now that there's a new president that's in place. Then there's all this change. We're getting now to the end of the first 100 days, and this has been sort of a shock and awe campaign, right? All this change, all these different things. So the conversations are around, what are the next 100 days going to look like? There's a lot of fear and concern over tariffs. And here's a couple things that I've just been kind of considering and sharing, and that is if we actually think about China's tariff relationship and how they've worked with the rest of the world, what have they ultimately done? They've taken a lot of the intellectual property from different companies and then they generically make it, etc. And I don't know that they've been the best trading partner. So I think that the United States recognizes a strategic positioning right now and that there's a real conversation. But there's no question the big issues today are that there's tariffs on the table, 145%, et cetera. The world's getting concerned.
Yeah, and what does this mean for equities? We've seen a lot of volatility. Do you anticipate that that volatility will continue? Are we range bound from here? How do our viewers make sense of it all?
Great question. I think that I wish I had the answer of everything, right? So I can talk out of both sides of my mouth on that, but I'll say I think that we still got a little bit more volatility ahead. The numbers are just changing right now. I think a lot of companies front run the GDP because they were thinking, hey, maybe a tariff shows up and that's kind of like, you're on the highway going down the road and now there's a new toll. Yeah. And so you go, let's get as much through as possible in Q1 and maybe Q2 is a little lighter. And so I think if we can see a little volatility there, that's actually going to cause more challenges in the stock market. And I think that there's a lot of companies today that may or may not do as well on earnings because they don't have as much cash or because corporate debt is very expensive or becoming due here in the near term. See, most corporations got a ton of debt in 2020, and guess what? 5-year terms come due in 2025. So we've got $9.2 trillion that's due within the next 12 months, and that's really the big story in my opinion. We got to get rates down in order to refi that debt, otherwise companies can't do it.
And a lot of your clientele, as I understand it, David, is people of retirement age. Now, of course, for every particular investor, an investment strategy might be different. Sure. What does this mean for retirees?
The goal is to ride bulls and tame bears. Right, so we want to, capitalize on the opportunities and also be anchored when things aren't as settled. We got to get our anchors in place, especially as we're nearing or entering retirement. Why? Because, well, let's just say that you lose 50%. It takes 100% to get back up to the top. So it's twice as hard to climb uphill. So it's really important for boomers to understand, or people nearing or entering retirement. So we think it's really important to also note that, bonds may have some challenges to them. If interest rates rise again, that's the seesaw effect. We lose money. If you get defaults in bonds, that could be a terrible thing. And so I think that there's alternatives that people should be looking at. And one thing that's become very popular is something called an equity indexed annuity. It's a growth-oriented product that has zero down, reasonable rates of return on the upside. Ultimately, I've never seen these products in sort of a better position than right now to kind of look like a bond, but none of that downside. So doesn't matter what happens over the next 20, 30 years of someone's retirement, good times, bad times, all together, reasonable rates of return, no big surprises. You want to be able to live to, have another day.
Where would our viewer find one of those?
You got to be able to work with an advisor who's going to sit down with you and help you to understand. And I'd say not all products are created equal. You really want to understand the terms. You want to understand the particular details to these things. But just to be clear, there's no such thing as a perfect investment. The goal would be to try to identify the perfect portfolio, the right balance, maybe of dividends, of the right growth. To be clear, I'm a big fan of growth still, although I do believe there's a little bit of volatility in the short term, but then we're going to be off to the races here come 26 and 27 as we move forward to the future.
And we do see that consumer sentiment has been weakening. Consumers are worried about higher prices. What more can you shed on that particular factor, David, in terms of how the consumer can fare in this type of volatile environment?
Yeah, well, there's 27% inflation that's really been added since the year 2020, January 2020. So if we look at the rate of change, that might be slowing down, but there's a lot of inflation that's still in the system here. So everyday America is really struggling right now. And so it's unsustainable that the top 10% of earners are 50% of all of purchases today. And so we're going to have to see a rebalancing in some of that. But ultimately, I think that, if I was giving advice to the average family, I'd say that we really need to learn how to budget. We need to learn how to do a spending plan a little bit better. Because if we just model our lives after the U.S. government, we end up in so much debt. And you got to ultimately do your own Department of Government Efficiency and lean some of those ideas out. So I think everyone should be paying attention.
We had seen an about face when it comes to President Donald Trump's view on the Fed chair. Monday, He was extremely displeased with him as he put on Truth Social. Tuesday, there was a reversal, and we did see the stock market, in fact, rise quite notably on that. What is the position that the Fed chair is in, and how do you expect him to respond?
Okay, so the Fed chair is not in a great position. I'll say this much. I think that we should be critical if people have real power to really affect our lives. And in the case of the Fed chairman, they certainly do. In this case, Jerome Powell's been wrong on every turn, in my opinion, as it relates to inflation. Is it transitory? We're not going to do anything greater than 50 basis points, 75, 75, 75. He's been wrong on every one of these places. So ultimately, he's in a weird spot because he still has this mandate. And by the way, he was appointed by President Trump.
Right.
So they actually do have a little bit of an okay relationship. It seemed a little bit political that he wasn't really communicating to Congress last year that the print and spend that was going on was really damaging the work that he was trying to do with higher interest rates. So I consider that a little bit political, as well as those cuts at the end of the year. So we have a completely different answer right now for what the Fed's response is going to be and which way they're going to go. So we're looking at higher inflation. You're in a rock and a hard place. I think you need to allow the markets to figure it out. This 2% number that they came up with, that's textbook stuff. That's not how free markets work. Supply, demand, there's a lot of variables that are going on here, and it's going to be a little bit volatile here for the short term. So watch him cut. I think he's ultimately going to backstop it. We're not going to get some major black swan moment.
All right, David Stryzewski, he's the CEO of Sound Planning Group, joining me in studio. David, thank you.
Thank you.